Hello and welcome to the weekly market metrics. I'm your host Sandeep and we are in week 2 of 2026. It's just 1 week in and DJT has already kicked up a storm. Referring back to an article about the state of India-US tariff deal I had shared in week 51 episode, it seems US is bent on having its way and markets are feeling the heat. As for price action, the year is off to a rocky start with all the indexes breaking important support levels. A disappointing departure from the bullish outlook many, including us, had for the new year. Anyways, let's check the charts and see how the price action played out, and we'll also look at what is possible in the coming week. As always, Nifty first. After making a new all-time high last week, Nifty saw a strong downside expansion. Markets go up the stairs and come down the elevator. This week proved it. The week's candle engulfed the last 7 weekly candles, signaling a clear shift in momentum. For the week, Nifty fell 645 points, down 2.45%. The weekly range was nearly 2x last week's range. Nifty took some support around 25,650 level during last hour on Friday and closed the week at 25,683. Immediate downside support now lies in the 25,500, 25,300 zone. When price is moving lower rapidly, resistance levels are no longer relevant. Last week there was no overhead resistance because we were at an all-time high. This week, I'm saying it just doesn't matter. That's how fast markets flip. The bias for the coming week is bearish till we at least cross 26,000 levels. On the daily time frame, Nifty printed 5 consecutive red candles this week, with Thursday and Friday showing strong downside momentum. The index broke all the key daily supports discussed last week, including 26,200 and 26,000, confirming a clear breakdown in structure. On Friday, Nifty nearly closed at 25,700, 25,650 support levels. It'll be important to watch whether price holds and reverses from this zone or breaks down and extends the decline. If 25,650 fails, the next major support lies at the 25,400 zone. With markets being down for the past 5 days, I just looked at how common these 1% and greater than 1% drawdown days are, and here is what I figured. 2025 was not that bad after all, and I hope 2026 stays in that 15-20 day range. Moving on to the hourly time frame, Nifty held above the 50 EMA until Tuesday. Price then chopped around the EMA on Wednesday before breaking down decisively below it on Thursday and remaining below since. At present, the gap between the price and 50 EMA is at 310 points or 1.21%, reflecting strong downside momentum. Will price catch up to the EMA as it mostly happens in short bias phases, or will this time be different? Your guess is as good as mine. You see, when the markets are going down the way they have been for the past week, long-only portfolios obviously bleed. At this point, I am reminded of something Niels Kastrup Larsen said in a podcast with me, and to quote him, he said, "Trend following is one of those truly non-correlated return streams. And that's the beauty and the reason why trend following should be in all portfolios, in my opinion." I couldn't agree more. By the way, the full episode comes out tomorrow on the channel. Do watch it. Moving on to Nifty's expected range into the coming Tuesday, 13 January expiry. If I look at the options data, the ATM straddle closed around 193 points, up 60 points or 45% from last week. The sharp down move spiked the straddle premiums, and option writers will be happy to see better premiums after a long time. With Nifty spot closing near 25,683, the implied expiry range comes to, on the upside, 25,876 and on downside 25,490. That's roughly 0.75% on either side. Looking at the OI data, on the call side, 26,000 call, 26,200 call and 25,900 call hold highest open interest. On the put side, 25,500 put is the only strike showing meaningful open interest and has the highest OI. Notably, there has been put unwinding from 26,200 down to 25,800. The 25,900 to 25,500 zone is showing up repeatedly across multiple analysis, making it a critical area to track. Next is SENSEX. On the weekly time frame, SENSEX fell 2186 points or 2.55% to close at 83,576. The only silver lining is the 83,200, 82,700 support zone, and price is currently holding above it. Similar to Nifty, the weekly range expanded sharply, with SENSEX covering close to 2,500 points or about 3%. Resistance is placed near 85,750 zone, which is still some distance away. The bias remains bearish for the week unless we see a decisive close above this resistance level. On the daily time frame, SENSEX printed 5 consecutive red candles similar to Nifty, breaking all the key support levels discussed last week. The next support is placed near 83,100 level, while resistance is at last week's close around 85,750, from where index sharply declined. The bias remains bearish, and let's see how the coming week unfolds. Talking about the expected range till the coming expiry for SENSEX. The next SENSEX weekly expiry is on Thursday, 15th January 2026. The at-the-money straddle closed around 837 points, almost 30% up from last week's 627 points. The expiry range based on straddle price comes to, on the upside, 84,413 and on the downside, 82,739. That's 1% expected move from the current close on either side till expiry. Moving on to BANKNIFTY. On a weekly time frame, BANKNIFTY lost 899 points or 1.5% to close at 59,251. This week's range was slightly lower than last week's, but it still remained above 2%, indicating continued volatility. Key support levels are at 59,000 and 58,600, while resistance is placed near 60,360. The bias remains bullish, in line with Nifty and SENSEX. On a daily time frame, BANKNIFTY printed 1 green candle this week on Tuesday, unlike Nifty and SENSEX where all 5 candles were red. However, Thursday and Friday saw fierce selling with large red candles forming on both days. The 58,700 level is an important area to watch. BANKNIFTY should attempt to find some support around this zone as it has bounced from this level in the past. Moving on to BANKNIFTY, on the 1-hour chart, BANKNIFTY broke below the 50 MA on Thursday. Looking at the weekly, daily and now hourly chart, BANKNIFTY appears relatively stronger than Nifty. However, the short-term bias remains negative till price moves back above the 50 MA, which is currently roughly 400 points or about 0.7% away. Talking about ROC or rate of change, we are in the second week of 2026 and all we see is blood on the street. All indexes closed in red, ranging from 1.5% to 2.5%, with BANKNIFTY falling the least. Apart from that, there's not much to see over here. Talking about the top sectors this week, all sectors in negative, but among the most resilient are Pharma, IT, PSU Bank, which was in the list last week as well, and then we have FMCG and banks. All defensive sectors have shown up this week. That's about it for sectors, and now moving on to range and expiries. This week saw a clear range expansion across indexes. Nifty, BANKNIFTY and SENSEX printed their widest daily range of the week on Friday at 318 points, 585 points and 1004 points respectively. As a result, Nifty's 5-day average range jumped to 205, up from 162 last week, making a clear expansion after a period of compression. Now let's talk about expiries. Tuesday's Nifty weekly expiry started with an extremely low at-the-money straddle premium of just about 85 points. Despite this, the index saw a swing of nearly 130 points on the upside, followed by 150 points move on the downside, before closing 71 points lower than the previous day. With such compressed premiums and relatively large intraday swings, it turned out to be a relatively tough expiry to manage for option writers. SENSEX expiry on Thursday was a different story altogether. What began as an ultra-low ATM straddle premium of around 260 points quickly expanded to 313 points after the Trump's proposed 500% tariff news hit the markets around noon. This was one of those rare expiries where straddle premiums expanded intraday. Post the initial spike, the index remained range-bound from 12 p.m. to 3 p.m., offering great opportunities for option writers. Overall, SENSEX saw a directional move on the downside, but the midday volatility spike caught many non-directional option writers off guard. Still, it was an easy expiry for direction sellers, tougher in the first half but quite rewarding in the second half. Talking about India VIX, as you'd have guessed, India VIX saw a sharp uptick of 16%, closing under 11. After staying low for a long period, a rise in VIX was quite expected. And for a change, that played out. Jokes aside, tariff-related uncertainty has clearly increased the fear, which is now reflected in higher India VIX levels and elevated option premiums as well. Talking about commodities this week, well, we saw silver on the top at 5%, then we had gold at approximately 2%, and lastly, crude at 2%. Copper seems to have taken a breather this week after a massive rally in the last 6 months. Natural gas, true to its nature and true to what I expected, is down 6% this week. In summary, after making an all-time high last week, markets saw a sharp reversal in week 2, with Nifty, BANKNIFTY and SENSEX breaking key supports after starting the year at record highs. Range expansion returned aggressively after a long phase of compression, triggering a spike in volatility and a meaningful rise in options premium. All sectors closed in red, with defensives like pharma, IT and FMCG showing a relative resilience while broader markets weakened. India VIX jumped sharply, reflecting rising uncertainty driven by tariff-related concerns. Overall, in just about a week, the tone has shifted to bearish and volatile. Momentum is now on the downside, ranges are expanding, and higher option premiums mean better risk-reward for option writers. Moving on to what caught my attention this week, one, I have been reading up on the US and Venezuela issue, and there are 2 articles that I liked. One is from the Time magazine titled "What's Happening with the US and Venezuela." Next, if you are keen on a critical view of the situation, the Al Jazeera opinion piece titled "Venezuela, American Regime Change with a Trumpian Twist" is a good read. Changing tracks, if you are a keen follower of the AI space, this Wall Street Journal article titled "How Google Got Its Groove Back and Edged Ahead of OpenAI" is a must-read. It talks about how after an early domination by OpenAI's ChatGPT, Google is staging a solid comeback. Lastly, how can I miss talking about Morgan Housel's latest post, "A Few Things I'm Pretty Sure About." No explainer needed for this one, it's better read and perhaps reread. All the links are in the video description. Now over to what to expect in the coming week. Next week is a full 5-day trading week and there are no major events lined up, and we cannot predict any geopolitical tensions anyways. Talking about the markets, the overall sentiment seems bearish to range-bound. On commodities, metals both precious and base should continue to be bullish. And with that, we wrap up this week's market metrics. If you find this series useful, don't forget to subscribe to the channel. Until then, stay curious, stay steady and enjoy your weekend.